Good afternoon, I'm Lynn Adams.
I'm Justin Gross.
Thank you for joining us on our 2024 Market Outlook call. Just a quick reminder that everything we talk about today is for educational purposes only. There's no investment advice in this, and we are a registered investment advisory firm associated with Cetera Advisor Networks. And with that, we will get started. We're going to start today a little different. So we want to do a little brain teaser right out of the gate to kind of see if we can catch you off guard, get you to think about something a little differently. So what you see here on the screen is a redacted list of about 15 or 20 of the most widely held funds in the US and their returns for 2023 and their returns for 2022, as well as a couple of the two indexes that most people follow, the S&P and the NASDAQ. The question is, if you look at this list, which fund do you feel like would have been the one that you would have liked to have? And what brought me to this is doing year-end reviews and kind of looking at statements and such. We have some funds that have done really, really well this year, but when I look at their actual account value over 2 years, the results aren't what you might think. So now that you've had time to look at that for a minute, let's reveal here. It's not any of these. These have 2-year returns that are negative. Even some of the thematic funds that were up almost 100% still are well off their highs, you know. And the correct answer would have been Fund A. I tried to make it easy, right at the top. But this is to illustrate that these spectacular returns from some concentrated funds in 2023 brought the markets back up to highs, but most people are not near the highs. In fact, some people are really off their highs. So that's just kind of an interesting illustration of a concept we call risk drag. If you have stuff that goes up and down a lot, when it goes down 15, 20, 30, 40%, you have to have ridiculous returns on the upside just to get back to even.
Yeah, it brings into play the old saying of win by not losing. Those dramatic down years are so damaging to long-term returns. It doesn't matter if you make 100%.
Right.
You're still down in the case of L, almost 36%. And that doesn't bring into play the investor psychology that you would have stuck around to even get the 100% return.
Yes.
Because when you're down 25, 30, especially on larger numbers, as nest eggs increase in size, 10% loss of $2 million is a whole lot different than it was when you had $10,000.
Right.
So would you have really stuck around to lose 30, 40, and even get the 100? You might have cashed out at down 25 or 30, I can't take anymore, and now you're stuck, right? So there's a lot that goes into this. It's easy to look at 2 years on paper, but you have to live this and make decisions, or not. Maybe that's the best decision to make, you know?
Yeah, it's definitely something that's a big deal. Like, it is hard to manage our own behaviors when things aren't working the way that we think that they should. So anyway, just thought everybody might get a little insight out of that, because it was alarming to me to see some of these incredible returns and yet realize, wait, some of these things aren't even back to whole, not even close. So we'll transition. Let's talk a little bit about the S&P 500. That's the 500 largest stocks in the US. And at this moment, we're really at the end of the year, it was approaching its previous high, which we found after the COVID stimulus in 2022. Now that index is 500 companies, and we'll talk about it a little bit later, but what really drove that back to that high level is really the performance of about 7 to 10 companies at the top of that index. We'll get more to that in a minute. As far as is it expensive, because I get that question a lot, is this a good time to buy into the stock market? And of course the answer to that question is, well, how expensive is it today relative to the earnings that those companies make? It's selling about 19.5 times earnings. That is definitely higher than the 30-year average of 16.5 times earnings, but it isn't radically high like maybe in the late 90s going into Y2K, or even at the height of the government handing all out that COVID money in 2022. But I'd say it's still a little expensive here.
That one thing before we move on there, that also your time frame matters. Is it expensive? Well, over a 1 to 2 year period, maybe much more so than a 10 to 15 to 20 year time frame. Yeah. It's not expensive, because it's going to be more valuable 15 to 20 years later in all likelihood than it is today. So the time frame matters into that decision as well a little bit.
That's a really good point, because if you get in it today and today happens to be an all-time high, 3 months from now it might be down.
Right.
But definitely 25 years from now, we would expect it to be much higher than it is today.
Going back to the psychology of you may never get those returns if you didn't stick around for them, it helped. If you know your time frame, it also helps deal with volatility. If I know I've got 15 years, I'm not as concerned about a 1 year experience.
Yeah.
So
That's a good point. I think the thing that people really need to understand more about this particular market cycle that is really unusual is that the dispersion of returns across all these indexes is really vast, and it is truly 7 or 8 companies that's driving it. So, for example, the NASDAQ index last year finished up over 40%. The S&P was up over 20. The Russell was, low teens, and the Dow was low teens. But that's a big difference in these major stock indices. And if you really kind of bury down into it, I'll use the NASDAQ as an example. I don't think people realize this to this extent, but there are essentially 8 companies. We're not allowed to say their names. You can look at the little icons here and figure it out, but we're not allowed to say the names for compliance reasons. It might be considered a suggestion to go and buy one. But these companies, if you add up the percentage that they make up of this $22 trillion stock index, the NASDAQ, they make up 47.5% of it. So if these 7 or 8 companies are doing well, it would be impossible to imagine how that index wouldn't do well, right? And that's just the NASDAQ. The S&P, the top 10 companies, this chart shows, if you look up at the top right-hand corner, is those 10 companies make up 32% of the S&P 500, which means there's 490 companies in the S&P 500 that aren't a part of that group. And on the left-hand side of this slide, it shows, okay, well, those 10 companies earned 62% total return in 2023, but the other 490 only made 8%. So as an investor, it's really interesting because if you are, say, older, or you've got $2 or $3 or $4 million, heck, you've got $600,000 and it's your life savings, I don't think you can take the kind of risk that comes along with saying, well, let me just go get 4 or 5 of those high flyers, because in a good year, they might make 60, but in bad years, they can lose 50 or 60. And we just talked about in our brain teaser that that's a problem if you don't have the risk capacity to own that kind of concentrated positions.
And it could be an unknown risk because you think, I own the S&P 500, I own 500 diverse, and you do, but in a small percentage compared to the top. And all of those 7 or 8 stocks are basically in the same industry, the same sector, one of the more volatile sectors. If it were 8 stocks, but it's a consumer staples company, it's an energy company, it's a technology company, it's a healthcare, you're still more diversified with the same number of stocks.
Yep.
When all 8 are in the same sector, you're more concentrated.
Which is technology services.
Technology.
So I think from one of the goals of the call today is to really help people realize just how narrow this market breadth to the top has become, and really evaluate for ourselves, do I want to be in that risky space? Maybe my time horizon is longer term, maybe I'm more risk tolerant, but then at the same time, if you're not a risk taker, or you're not comfortable with lots of volatility, you have to realize it is just not prudent for you to have too much exposure there. Some of the other benchmarks that we could just bounce through real quick. Obviously, we talked a little bit about the NASDAQ and the S&P. The international indexes was up 18 for the year. Russell was up 16.9. Emerging markets are struggling. I think there's a lot of issues structurally still going on in China and some of the emerging markets with COVID issues. They're up 10. And the bond market had like the surprising, bottom of the 9th inning recovery. Like, it was negative all year, and literally in the last 45 days of the year, it ended up going up to a positive 5.53%. That had much to do with the Federal Reserve's shift in their view that inflation is less of a problem than we thought it was going to be, and that led the market to believe interest rate cuts may be coming sooner than we thought. But while rent rates are still high, I want to talk about our strategy, our overall portfolio strategy for most of our clients. If you are in a diversified portfolio and we have money in the stock market, we have a bias right now towards value stocks more than the high flyers. The reason for that bias is a couple of reasons. One is that historically, when interest rates are higher, value and growth, like let's say treasuries are in the 3 to 4% range, they tend to perform about the same. When treasuries are at 4%, 6% higher, value has had a historical return advantage over growth companies. So that's one reason. The other reason is that the top 10 companies are growth companies, and they've had an incredible run up. as interest rates begin to level off and go down, we think that the market will broaden out. More companies will go and borrow to grow, or they'll loosen up on some of their CapEx spending. Like the tide will move all ships in the same direction once the playing field becomes more balanced. So we have more in value than we have in growth, and we plan to keep it that way until rates come down noticeably.
We started to see that in the fourth quarter too. The breadth of the end of the year rally was not as narrow as the first half to 3/4 of the year.
Yeah.
When growth stocks were up and everything else was flat, maybe even negative in large. But that it did broaden out a little bit at the end of the year, and also just a classic concept of reversion to the mean, right? As always.
So we think that value is probably going to be positioned to give us, I wouldn't necessarily say higher returns, but the return it gives us, I think it will get it for us without as much risk, as much volatility. And if we can get the same return with less risk, that's a better overall proposition for our clients. This next slide talks a little bit about inflation and interest rates. So when rates are rising, companies like hold off on borrowing to grow, they hold off on taking bets. A lot of companies are leveraged. The real estate industry, as an example, if interest rates are higher, less people are building, less people are buying, less people are willing to sell their houses. So there's a correlation to higher rates and less profitable outcomes for most businesses. We can look at inflation to try to give us a judge of when are we going to get to this magic number. The Fed wants inflation to be at 2.5%. That's their goal. So we can see that we've moved in the last 2 years off the highs dramatically, and CPI is down around 3. And actually this next slide shows us that even when you look at PCE, which is the measurement that they look at, which is more like core inflation, if you measure that annually, we're still maybe 0.75% away from where they want to be. If you measure it on a quarterly basis or a 6-month basis, we're there now. So our belief is that the inflation battle, they're going to probably declare victory on here shortly, and then that would lead to, hey, let's go to our second agenda item, which is let's stimulate job growth so we can get more people working, more higher incomes. So I think that the rate cut outlook is beginning to get on the radar. The last thing that I think is relevant to mention in regards to inflation and how that might play out is that a big portion of the inflation that we've seen in the last couple of years has come from all that COVID money the government was doling out a couple of years ago. Wealthy people didn't really need it. They stuck it in their savings account, and then when COVID was sort of over, if you will, from locking us in our houses, they want to go out and travel and visit and go to events and things. So we've seen that $2.3 trillion of excess savings at the peak sort of starting to get spent down to where now there's only about $1 trillion left in that extra savings. So if you sort of forecast that forward, we probably got another 12 months, maybe 18 months before that burns off and we're back to like long-term normal average savings. And I think that'll slow spending down when we get back to those average savings amounts. Talking a little bit about interest rates, another thing that I feel really is going to play into this is that if the Fed does not lower rates, the cost for the debt for our government to pay on all of its loans and borrowed money really skyrockets our national debt, accumulated national debt, into the future. And I don't think anybody wants that. The government doesn't want that. Republicans don't want that. Democrats, no one wants that. So I think it is like a bipartisan belief that we should make our borrowing costs as low as possible. And I would expect to see that also weigh in on, hey, can we get these rates to start coming down sooner than later? Speaking of political matters, presidential election year, always a lot of energy around these years, and some of that energy, a lot of that energy is negative. If this person wins, things are going to go off the rails. That sort of mentality plays into the markets. But we always like to remind our clients in these election years, presidential election years, that if you look at history, and this chart shows this, is not really a pattern. I mean, if the Republican Party is in complete control of the White House and Congress, that would be the red bars here on this chart. If the Democratic Party is control of Congress and the White House, that'd be the blue bars. And when they're divided, that's the gray bars. And I've stared at this graph a lot. I don't see a pattern. I don't see any real way that I could say, well, if this happens, then statistically it is more likely that, we'll have more GDP or less GDP or more returns. I don't think there's a pattern. So let history guide us in how we handle our financial decisions, more so than what our emotions might make us feel about just the difficult political landscape that we really have.
We've done this long enough. I've experienced this. I've had clients call shortly after an election, day after an election. My person did not win. Sell everything. Let's go to cash.
Yes.
Making a market decision based off an emotional decision.
Mm-hmm.
Now you can totally disagree with policy, and that's everyone's right, and go vote. And I've had the opposite when the other party won. The same thing. The only common theme was they were both wrong.
Yeah.
They were both wrong. And the market, because the market does not care. Market cares about earnings
And sustainability.
Sustainability, they don't. It's they don't care. And I think this data proves that.
Yeah. So we just encourage everybody to try to separate your financial decisions for your lifetime of goals and ambitions and financial dreams and outcomes from how you might feel about who's going to lead our country in the next 3 or 4 or 5 years, and look at history as a guide. Like it doesn't seem to favor one party or the other. One thing that does occasionally pop out is the fact that the presidential political year tends to be a little better return than the other 3 years in a 4-year cycle. Not by a lot, but there is statistical evidence to show that in a presidential election year, returns tend to be a little better. And the argument would be that the current incumbent would do all that they can with policy to make it really grease the tracks for fast growth in that year. Because we want you to feel good when you go vote.
Yeah, I'm just thinking like houses tend to look better right before they sell.
Hey, that's true. That is a great analogy. That's one thing you're known for, Justin. All right, so moving on. So when we put all that together, I think this is the message. We really got to be patient here, and most everybody that we serve has a diversified portfolio. This chart shows the 1 year return, 1 year, 5 year, 10 year return of stocks and bonds at large, and it shows the ranges of outcomes. And as example, 2022 was a rotten year. Stock market was down anywhere from 25 to 35, depending on what part you own. The bond market had one of the worst years in recorded history. It was down 13. Most of our clients owned both of those things, and so your outcome was very unpleasant. All of our outcomes were very unpleasant. That said, if you look at that through a little wider lens, you back up and get a 5-year view or a 10-year view, having a diversified portfolio has produced consistently positive returns, and consistently positive returns in a tighter and tighter band if you have a diversified portfolio of stocks and bonds. So I don't think that we could argue that you should run out and buy a bunch of stocks because of this, or you should run out and buy a bunch of bonds because of that, or you should switch back and forth. Rather, we could argue for patience and just stay diversified. I do want to switch gears and talk lastly about bonds. We are at a moment in time where the yield on bonds, interest rates are very close to the highest point that they've been in my almost 30-year career. And they rose really rapidly. Like the federal funds rate went from 0.5 to 5.4 in right at 2 years, and we are holding at that level. When people make a choice to buy a certain amount of stocks and a certain amount of bonds, they are weighing the certainty of the interest payments from the bonds against the uncertainty of the stock performance, but realizing that stocks perform over time. And so we see people choose to have these diversified portfolios. 20% bonds, 80% stocks might be more appropriate for a growth investor. Someone that's going to retire in the next few years might be 60-40 bonds to stocks. Somebody that's already at retirement might be 80% bonds to stocks. But we all choose a level of risk that we want to get in our portfolio that aligns with an expected return over time. This is the really important part right here. those statistical outcomes over the last 15 years, and you could do it even longer, are fundamentally changed if interest rates stay high. I'm gonna give you an example. If interest rates stay 2% higher now than they were 2 years ago for the last 20 years, a couple things happen. The 60-40 bond to stockholder is probably gonna make more money than they would have made before that, because the yield on the bonds is gonna have a significant increase in their return. And also, the expected return on stocks, the 100% stock investor, actually might be a little bit lower, because there is a substantial portion of investors that buy stocks for the dividend yield. There's a lot of people that say, I'm gonna go out and buy this stock or that stock because it's gonna pay me a dividend of XYZ, and they're buying it for the consistency of that high dividend. But if interest rates are higher and you can go get a CD or a short-term bond that pays that same dividend and not have to take the volatility risk, it makes the bond more attractive. In this next slide, just to illustrate this point, if interest rates stay elevated, say 4% higher than they've been over the last 25 years, which is where we're at now, the return for a 60-40 bond portfolio relative to like an 80-20 stock to bond portfolio, it becomes closer. Like the return in the future would be expected to be more similar versus much more noticeably different. And I think that's really valuable for our more conservative and our total return investors to realize, is that while these interest rates are elevated, there's an opportunity in the bond market that is really, really good in terms of risk return.
Yeah, this is a welcome scenario for conservative retiree and the demographics of retirees. It's kind of a good timing for a lot of folks as they get into retirement or maybe reduce risk in portfolios. But this is such a drastic difference than the past, really going all the way back to 2008. We were in a 0% environment for so long, where you had to risk it to get it. I mean,
even negative real rates. Rates were lower than inflation.
They're just trying to push you out on that risk curve. But now you can make, something with these elevated yields. It's very welcome.
So as an example, and I'll wrap this up, let's say you had 60% bonds, 40% stocks, and let's say that you made a decision to invest in that strategy based on a lower standard deviation, lower average risk, and over the long run, that strategy might have an average annual return somewhere around 6.5%, which is sort of the gray line on this chart. If you assume that interest rates are gonna be 4% higher than they have been for the last 20 years, which may be a little higher assumption, but to illustrate a point, that would be the pink line. And if that happened to be the case, your expected return would now be somewhere in the 8.5%, 9% range. You didn't change your mix of assets. You didn't change how much stock you own. That is the riskiest part of the portfolio, but your expected return now has gone up almost 2.5% a year, just based on the bond market having a different rate environment.
To take this concept and to make it real, there's a lot of folks through reviews we're finding that are still living in that last 15-year environment with cash, too much cash in checking. I mean, somebody's gonna make the interest on that money.
Right.
And so if you are carrying too much in that old regime checking at zero, basically, you're missing out on 5%. I mean, so always pay attention to your cash positions and make sure that in an environment where yield is available, that you're getting it.
Yeah, if you're in anything under 4, you're probably letting somebody else make money on your money that they don't even have to take risk to get. Most of the money market positions are in the mid 4s, low 5s, a couple even like 5.4. So if you don't have that, reach out. We can help guide you to where you can find some of that. This chart, just a last reminder, the markets always climb a wall of worry. Like there's always something we can worry about. This year it's going to be the presidential election. A couple years ago it was COVID. Before that it was the oil spill in the Gulf. Before that it was this. Before that it was that. It's always going to be things to worry about. Time heals all of these things, and so you got to stay the course and be patient. It definitely is important to stay focused, stay disciplined, don't worry about these current events so much. So here's the conclusions. If you're an aggressive strategy, you're a risk taker, let's talk individually about, do we want to take more exposure to, say, some of these Fab 7 stocks? Because we can do that, and we have some folks that like to do that. It is a very, very concentrated bet environment, and it may or may not work, but if you're a risk taker, that's something that we can talk about. If you're more of a total return, moderate risk, you're not comfortable with a lot of volatility, you need to realize that if you own more and more of those stocks, you are asking for a bad day at some point. Now that might be a bad day after 3 great years of returns, but they're volatile. The negative years of those high-tech, high-flying giants are going to be a problem for somebody at some point. Interest rates, we expect them to stay elevated, meaning they're in the range that they're at now for the next 18 to 36 months. I think we'll see some cuts later in the year, but they'll probably be slow and steady. So this interest rate environment where we can get higher returns on bonds is going to be there for a while, and our bias towards value stocks versus growth stocks is going to remain that way as long as, say, the 10-year Treasury is around 4% or higher. The certainty, the probability that rates will come down, it looks pretty high. I mean, for all the factors we talked about, it is likely that they will come down. I think the key is don't get stuck where you're at. Like, use what makes sense in this environment, and as rates come down, we need to make some changes to take advantage of things that work better in a lower rate environment. So don't just put on your goggles and not pay attention. That's an important piece. It's a presidential election year. We talked about that. We don't know that that's going to be a good thing or a bad thing for the market. Just make sure you have the right mix of assets and stay the course. And then lastly, we talked about the bonds and how these higher yields create a different environment for investors to choose risk. And if you have more bonds now, you're getting a higher yield. And if interest rates go down, you'll actually get a little kicker. And the return on that might be as good, maybe even better than some stock sectors. So this is a unique time to own bonds.
Yeah, there's some bright spots out there, and it's unusual given the last 15 years that many of the opportunities are in the lower end of the risk spectrum, and that just hasn't been there for a while. So it's certainly something to look at and talk to your advisor individually about what that means for your portfolio.
So that is it for our conclusions. I just want to let you know we're going to be doing the market outlook. We're going to be shifting from doing it quarterly to doing it for sure once a year. And if mid-year, if things are dynamically different, we'll do a mid-year update as well. But that's it for today's 2024 market outlook. Thank you.